And we're going to go over the question of, if the silver contract breaks or the gold contract breaks, will it bankrupt one of the U.S. banks? And is that derivative trade in the precious metals enough to drive one of the banks to bankruptcy if they're caught too far short? This has been a big debate in the gold and silver industry for quite some time, and I'm going to give you my updated view on what could happen there. Hey everybody, this is 𝙎𝙐𝙋𝙋𝙊𝙍𝙄𝙇 with the Freedom Report. We're recording on September 16th, 2025. We wanted to do an update on gold and silver. I think there's a lot happening in gold and silver. I haven't reported on this in just a little while, but we're going to go through all the data. I'm going to show you essentially what we've got going on in the market. We're going to talk about why gold is going up. We're going to talk about this debate about whether gold is overbought technically and whether it's due for a correction. We're going to go over the actual deliveries on the COMEX here in the US. We're going to talk about Tether getting involved in gold directly. And I'm not talking about Tether Gold, I'm talking about Tether and how that could change things for the gold market. And we're going to go over the question of, if the silver contract breaks or the gold contract breaks, will it bankrupt one of the US banks? And is that derivative trade in the precious metals enough to drive one of the banks to bankruptcy if they're caught too far short? This has been a big debate in the gold and silver industry for quite some time, and I'm going to give you my updated view on what could happen there. Since this is a data-heavy presentation, as always, we're going to do the share, and we're going to talk about all of the things that I just previewed. And we're going to start off by looking at the employment situation. Here we're looking at the BLS website here in the United States, where they're talking about the employment situation. These were the employment numbers that got reported at the first week of September for August. So it's a backward-looking report. And I'm just going to read to you the first couple of paragraphs. According to the BLS, the total non-farm payroll employment changed little in August. It was up only 22,000 and has shown little change since April, the U.S. Bureau of Labor Statistics reported today. The unemployment rate at 4.3% also changed little in August. A job gain in healthcare was partially offset by losses in federal government and in mining, quarrying, and oil and gas extraction. Now, in a minute, I'm going to show you where the BLS has done the biggest revision in history, and this isn't quite correct what they're saying, but I'll do that in just a moment. But in terms of the August numbers, this is what they're reporting, is basically no growth in jobs, essentially dating back to April. And in fact, when we look at the revision that's been announced here, we're going to show how there haven't been nearly as many jobs created in the last year as we thought. It says this news release presents statistics from 2 monthly surveys. The household survey measures labor force status, including unemployment by demographic characteristics, and the establishment survey measures non-farm employment hours and earnings by industry. So those are actually two different reports. And what I want to point out here is that the household survey is a real survey. We're asking actual households, and the establishment survey is where you're getting data and it's not quite correct and they have to revise it. And the establishment survey is typically where the revisions come. And the household survey and the establishment survey were different for the longest time until the BLS announced that it was going to change the way the household survey was calculated, which they made some revisions. And ADP, the independent payroll processor, has also changed their reporting to match the BLS. So I think that people have centered more around the BLS establishment survey, and we get less truth overall in the employment numbers than we have in the past. And we see that in the revisions. As we go over here to a Zero Hedge story, it says 2 weeks ago, before both Bloomberg and Reuters, Zero Hedge told our subscribers to base for another huge negative payrolls revision. And in fact, BLS admits an all-time record of 911,000 fewer jobs were added under Biden as they go back and look. Why? Because of the revision history and how they do it. So a record 911K payrolls for the period April 2024 to March 2025 will be revised away. So almost 1 million jobs that we thought we had gained have now been pulled off as they go back and look at the data. And this article describes why they do the revisions, and it has to do with the way that they calculate the employment statistics. And it goes back to the two reports the household survey is the more accurate one because you're asking actual people, and the establishment survey tries to measure all these things, but they have to revise it down when they realize it's not correct. And if we go look at this chart, the total non-farm, according to the BLS, was revised down 911,000 from April to March, and it was a benchmark revision of a negative 0.6%, the biggest revision in the history since the BLS has been doing it. So, and we see that confirmed by a story from Newsweek. 2025 sees a rise in Americans living paycheck to paycheck, and that's because not enough jobs are being created and inflation is eroding the value of the dollar that people use to buy goods and services. According to Newsweek, a growing share of U.S. workers are struggling to cover expenses as everyday costs continue to weigh heavily on household budgets, according to new survey findings. PNC Bank's annual Financial Wellness in the Workplace report shows that 67% of workers now say they are living paycheck to paycheck, up from 63% in 2024. That's 4% of the entire U.S. workforce in a year has started living paycheck to paycheck. Let me say that again. That's 4%, 1 out of 25 people within the last year have now begun to start working paycheck to paycheck. Well, wait a minute. If we are creating all these new jobs and jobs had not substantially changed in the last year, according to BLS, when they're ignoring their own revision down, why would people be living paycheck to paycheck? Well, one, less of them have good jobs, and two, the inflation is basically killing people to the point at which whatever they were making is not enough. In other words, wages are not keeping up with inflation, and jobs are not keeping up when you revise them down by 1 million to the amount of jobs that people need, employment growth, immigration, all that into the United States. And so unemployment is at a sticky, I think, 4.8% or something like that, according to the government. And it's not really going down because of that. And those numbers don't measure the disaffected that have been unemployed for a year plus, which simply fall off those numbers. If you look at the year plus unemployment, it's much, much higher. We have a substantial amount of the American workforce ready and willing to work that can't, and it's up in the high teens. In fact, I think the latest numbers from Shadow Stats are well into the 20% range. So we are at about the same place we were during the Great Depression in terms of overall net unemployment, and especially when you add in the effect of inflation, the amount of jobs that are more part-time than full-time, people having less overall income. This article seems to make sense that, yes, an additional 4% of the entire workforce now has to live paycheck to paycheck. And this is just from last year. This is just a change in the last year. This is not in the last 20 years. This is in the last year. And what do they say is the cause? Rising costs outpace wages, according to the article. Household budgets have been stretched thin in recent years as the cost of living has outpaced wage growth, according to Newsweek. Inflation surged throughout the pandemic and costs have continued to grow, with consumer prices rising by 24.6% between August 20 and August 2025. Actually, if you use real data and not the revised U.S. numbers, it's risen by much, much more than 24%. But in any case, inflation is rising higher than wages, and the jobs are getting less quality, more part-time, less full-time. And when you consider the fact we actually have less than was originally reported. So when you add all that up, the American consumer is not in great shape. And the fact that we're even able to hold up spending in this country is due in large part to the use of credit growth. And we saw a 16 billion increase in credit growth in August from previous months, and it's starting to tick up again. It's not quite the 35, 36 billion we saw at the height a couple of years ago when people are really struggling, but credit growth is rising in the U.S. over the last few months. Because why? Because wages and jobs aren't keeping pace with people's need to pay bills, to pay for rent, to pay for housing, to pay for cars, to pay for groceries, to pay for schooling and their children and everyday expenses. And it's starting to wear down the American consumer to the point of where the Fed is expected either today or tomorrow, usually the second day. But by the time you see this video, we'll have the announcement of the Fed more than likely cutting interest rates. And the only question is, are they going to cut it by half a point, a quarter point? Experts vary, but they're expecting at least a quarter point, some expecting a half point to be cut by the time you see this video. Now, what's going to happen to gold when that happens? Well, essentially what happens to gold, and we'll get over this picture in a minute where we talk about gold production. As you're looking at this, almost always when you have higher inflation and you have the economic situation you have and the Fed cuts interest rates, it's almost always positive for gold. So we have this positive forward-looking gold catalyst, which we'll talk about in a minute. at the same time that the gold chart looks overbought. And that's going to cause some confusion as to where gold's going to go. Is it going to go up or is it going to go down? And it could do both. And we'll talk about that in a minute. Before we get into that, there's this really cool chart by Visual Capitalist, which just tells you where the gold's being produced and how much. And so this is as of 2024. The world produced 3.6 thousand tons of gold, about 500 tons across North America, 519 tons across Central and South America, a big mining district. Africa had over 1,000 tons. They're producing the most. I bet a lot of people didn't know that Africa is producing 1,000 tons, and Ghana leads the way with 141 tons. You got Mali, South Africa, Burkina Faso, Sudan, Guinea, and others right behind it. In Asia, China, Indonesia, Philippines, I think that's Turkey, and other Asia, you have 665 tons. The Russian, Uzbekistan, Kazakhstan, and other CIS countries, 584 tons. And Oceania, which is Australia, Papua New Guinea, and I believe New Zealand and Europe, is 46 tons. So Africa, by far the biggest producer, followed by Asia, and then the Russia bloc, and then Central South America, North America. So a lot of, by the way, 3,000 tons is a herd. Where did all that go to? Some of it jewelry production, some of it use in main boards and electrical computing uses for gold, and the rest went into storehouses, whether it be, you know, in your safe at home or whether it be in the central banks, which are the largest buyers of gold. Interesting. I thought it'd be interesting to see where all that gold comes from. And if there is a robust amount of gold trade, now is it going to be enough? Well, let's look at the charts and let's try to figure that out. So as I said before, it looked like gold price would rise, especially if the Fed indicates that they're going to cut rates in a rising inflation environment. That's almost always bullish for gold because it means we're either in a recession or headed towards one, and typically gold goes up. Now, I have said many times, I think we've been in a recession since 2008, and I think we're headed for a global depression according to the economic numbers. And that's if you believe all the country numbers. But if you believe what's actually going on in the real world with people, it's very easy to see. And I just got through traveling around the world the last year at several different continents. And certainly when I spoke to financial experts, government advisors, government people, when we interviewed them, and just people in and around business leaders in and around those areas, I noticed that the outlook economically is not rising around the world, it's falling. And so I think it's very clear, this anecdotally, we're heading into this global depression. And I think that's why you've seen the gold prices rise so much. And it's interesting as we look at the chart, you guys know from following me that I like to plot out Fibonacci's. And what is Fibonacci? It's a mathematical relationship you can use in investing to show where something is at. And a lot of traders use it to trade to certain targets on the chart. And it's basically just a mathematical expression of typically where things will land, and it can be used in trading. Now, as you can see back, around May of 2024, and this started in February, but February through May, we saw gold punch through its previous all-time highs and further into positive territory, positive over 1 Fibonacci. And now we're pounding up against the 1.618 Fibonacci. It just means that we're in the middle of a raging bull market that's not going to stop. And we've reached a new all-time high in gold. Right now it's trading, I think the prices have it at 36.8922. And it's sitting in all new high territory. And if you look at gold since dating back to 2000, it's basically beat all the major stock indices, U.S. stock indices, real estate, all those things. Gold has absolutely been raging. And over the last 18 months, you can see that it's gone up quite a bit. In fact, this rally really began, I want to say it began in October of 22. It was after COVID. We had sideways movement. Then you had an up movement, then a plateau until February 24. And then since February 24, it's moved from 2,060 to 36.89, almost doubling in 18 months. So we've had this major move, and we're actually almost in a new Fibonacci range. If you look at this, we're about to create a new Fibonacci on the chart, just a raging bull market. The problem is if you look down here, we have the RSI indicating that gold is the most overbought it's been, really dating back to the last financial crisis. You had an RSI rating of 85.85 in February of 08, right before the financial crisis, where gold was overbought, and then it went to oversold as the whole world moved into physical gold. And are we reaching that again? Is this a signal of a crisis that gold is overbought, and then we're going to reach a crisis, and then there can't be an overbought because everybody's going to buy it? I think that's what the RSI is indicating in the medium to long term. However, in the short term, the RSI, relative strength indicator, is indicating that at least from a technical perspective, gold's prices run too high. And that makes a lot of sense because we're reaching not only new all-time highs, but on the Fibonacci chart, we're breaking new ground into the strength and the length of the overall bull market. And it makes sense that that would have to happen under a relatively strong bull market, and then it may pull back. So in normal circumstances, and in the short term, we could see gold pull back just a little bit. And it wouldn't surprise me if it pulled back to like this last plateau, which is around 3290. It could. It traded 30 and that plateau around 32, 3300 between basically March of this year and in the summer when it broke out in July. Now, gold is not doing what it typically does. Typically during the summer, it'll fade until about mid to late August, and then we'll see if we get a rally. But gold didn't do that this year. It's been going strong throughout the summer, dating all the way back to June. You see this plateau and you expected a retracement. It didn't happen. And the RSI indicator the whole time is saying it would happen, and it hasn't. And with the Fed announcement coming by the time you watch this video, likely a cut in interest rates, it's almost would be impossible for gold to pull back. Now, it could have a short-term pullback and then an acceleration forward. But I think we're seeing is a breaking of the charts. As we look at this technically, if you look at the indicators, this chart is looking at back to 2000. In other words, looking back to old times in which we had a stable dollar, stable debt levels, and a stable world in the United States. That led to relatively stable gold prices, even going to the 2020, the pandemic. It wasn't really till the pandemic. I mean, gold had risen, but it wasn't really until 2008 with the financial crisis and the pandemic, which really brought investors' eyeballs onto gold, and in consecutive sort of time periods to where I think the generalists are now looking at getting interested, and people are looking at getting interested. But we've had all this economic uncertainty, which I think is pushing people into gold. And that's why the technical indicators are saying it's overbought, but it keeps going, because the technical indicators are measuring it per the old world, the old system. But now we're firmly in the era of de-dollarization, deglobalization, rampant, what I would call deflation in the world economy with excessive amounts of money printing. And all of those things together are driving gold past where we would look at it in a normal world. So I don't think we're in a normal gold market. I think we're in a raging bull market. And these technical indicators are going to get challenged and changed over time as we set new highs. Now, could gold come back in the short term? Absolutely. But if by the time you see this video and the Fed has lowered interest rate, cut rates, we're likely to see a big surge in gold. I think we'll actually have a collapse in gold short term as people move out of positions. And short term is probably going to be a few days. And then we're going to have the resumption of the raging gold bull market. And you're going to look at these technical indicators and say, they're broken. We've literally broken the technical chart on gold, and it's just going to keep rising. Why do I say that? Because from 1971 to about 2008, you had a certain trading range on gold, and then 2008 broke it. 2020 broke it again with the pandemic. And now what we're seeing around the world going on, the wars and the uncertainty, the financial issues, we're not in your dad or your grandpa's gold market. This is a completely new gold market, and I just wanted to point that out. Let's go to silver. Silver has had a nice move since the last time I talked about it. We were in this Fibonacci. We haven't gotten up to previous all-time highs, which is right here, which would be around $49.50 in that range. So we're sitting down in here for the longest time. In fact, silver was just kind of doing this big cup and handle. And you notice it's a 50-year cup and handle. Well, that's 2011. Here's the 50-year cup and handle. And then it was a deep handle, and then we've seen a move up, but it's not been the normal cup and handle. It's not the normal cup with a little handle and straight up. It's been this up and then down and waggle and then go up. And so silver, even though gold's had this massive move into a breakout, silver really kind of hasn't. It did get through 30, which is sort of the Maginot line, and then it quickly went through 35, and it stayed there for a while, and then it went through 40. And it's had this big move on the back of gold's move. But whether or not silver is going to continue to move really is a function of two things. Do we have industrial shortages? And has that finally broken the amount of above ground silver that we have because of industrial demand, which we're getting really close to? And I saw an interesting quote from the Silver Institute on the fact that the mining deficit to what we're demanding is really draining global inventories. We saw that crisis on the London market with regards to silver. We've seen some issues on the COMEX market with regards to silver availability in physical form and amount of deliveries, which I'll get to silver deliveries here in a moment, which have spiked up this month. And I think what we're seeing is a renewed interest in silver, not just because of industrial demand, but because of uncertainty in the market and people that can't afford gold are buying silver. And so now physical silver is starting to get really interesting. We've had a breakout on the chart, and it's not quite as high in the RSI chart. It's only at 75. So I think silver has more room to run. And I think what's going to happen is we're going to see if gold confirms silver's move. If we have an interest rate cut and gold continues to move, silver's going to go. If gold starts to pull back, I think I think silver will run for a bit, maybe to 41, 42, 43 in that range. Right now it's at, 42.52, so maybe 42 to 43. And then it could pull back if gold pulls back. If gold doesn't pull back, silver is going to keep running. And is there physical demand on the COMEX for gold and silver? We're going to look. So this is the COMEX 100 gold futures. So you get 100 ounces of gold per contract, and we're looking at the numbers. And gold, really, physical deliveries this month have been light. I personally think in December, which is end of year, we're going to get our next big amount of physical gold delivered. But this year, if you just look at the numbers have been exceptionally high pretty much throughout the year. This is the first year I've seen it to where you've had really high delivery numbers compared to previous years in almost every single month. September is actually starting off with a whimper. The rest of the year has actually been much stronger, with the exception of July. So physically, you've seen a lot of interest in gold this year. In the last 5 years in general, you've seen more gold delivered on this market than you traditionally have. If we go down to silver, that's on page 24. We're going to write down to it. Almost there. And we can see what's happening in silver. This is the 5,000 silver futures, the big contract. It's the 5,000 ounce bars, if you will, the 5,000 ounces per contract. You're looking at really high deliveries. If you look at silver the rest of the year, it was higher in 2 other months. In May, you had 15,000 deliveries of 5,000 ounce silver. In March, you had 16,000. And this is the 3rd largest month. And September is not typically the biggest month for gold or silver. But for silver, it's been big. It's 12,409 contracts. You can see down here at the bottom of this column. See if I can just highlight that column. So September, you go September here, you go down 12,409 of 5,000 ounce silver. So that's a lot of silver being delivered, and there's a lot of interest off the American market. So I think the physical run on silver is starting to begin just like it began in gold at the beginning of this year, and it's starting in silver. And that goes to the typical move as silver comes after gold. You had the big move in gold for about a year and a half, and now silver's starting to catch up. Now, whether they pull back in the short term again has to do with the Fed and rates, and whether the Fed's decision will overpower the technical charts, which say both gold and silver need to pull back technically. But if the fundamentals are that we're going to unleash more money by cutting interest rates, gold and silver are going to catch a bid and they're going to continue to go up. All right, now big news. This is not Tether Gold. This is Tether proper. One of the biggest I think the biggest stable coin in the world, one of the biggest, certainly in the United States, is eyeing gold miners in strategic investment talks, according to 𝙎𝙐𝙋𝙋𝙊𝙍𝙃 News. It says here, September 5th, 2025, stablecoin giant Tether is in talks to invest in gold miners. This move highlights a strategy to diversify crypto profits into tangible assets like gold, strengthening the future of digital commodity-backed finance. Now, with the amount of money that stablecoins have coming in, if they start investing in these different areas of the market, you're going to get a boom in the gold miners because there's going to be a lot of investment. And I don't know how Tether's going to choose them. Are they just going to choose the big guys that are in the GDX? Or are they going to choose, how are they going to choose them? I don't know. But it should uplift the whole sector. And so it looks like we have some bullishness coming to the commodity sector, specifically gold, in the terms of some of these crypto and stablecoin profits and holdings needing a place to go as more people pile money into stablecoins. And now it's starting to work its way out to the commodities. And I don't think gold and silver is going to be the only area to invest in. I think you could see it in uranium and copper, in iron and tin, and in some of the base metals as well, depending on how much of those is needed around the world. Copper certainly should catch a bid from the stablecoin complex at some point because it's needed to electrify much of the third world, including Africa, parts of India, China, that kind of thing. And countries like China that are now first world, they're still needing to electrify. And so the copper demand is going to be huge in the next 20 to 30 years. And so I could see some of the stablecoin revenue moving into the commodities complex and bidding up the commodities. And whether that's a good thing or not, we'll have to see. We'll have to see whether it creates an artificial boom cycle in commodities, which is not supported by the fundamentals of world trade. We'll have to see. But it's interesting now that you're seeing the stablecoins flush with all this money, because they've really come on the scene the last couple of 3 years, now putting it into what? Into real tangible goods. I felt like that was interesting. In addition to that, we're going to go over, I wanted to answer the question, if one of the 4 big banks, and I'll show you the banks, this is on the Office of the Comptroller of the Currency Report. This is the quarterly report on bank trading and derivatives, first quarter 2025, from the Office of the Comptroller of the Currency, U.S. office, which talks about derivatives. And I'm going to walk you through this, and I'm going to show you how much of the precious metals derivatives are in gold and silver, and we're going to show you which are the banks that have it. And we're going to look and see whether it's going to be the silver or gold derivatives that break the banks, or if it's something else entirely. Because I've been seeing interviews out around, well, if the silver shorts lose and silver goes to 50, 60, 70 bucks, and those shorts have to pay out, it's big enough to actually bankrupt one of the banks. And we're going to look and see, are those silver and gold derivatives as a percentage of all derivatives really the existential threat, or is it the other derivatives like the money derivatives and the other product derivatives that all these banks are trading in? And derivative complex is expected to be about $2 quadrillion worldwide, a little bit less than that. So it's really big. So here we see derivative contracts by product. So this is breaking it down, whether it's a credit derivative in green, a total swap in orange, an option in dark green, or a futures and forwards. Now, technically on the COMEX, there are options and futures. Now, options are basically when somebody, if gold or silver hits a certain target range, you're in the money if you are on, long or short on the right side. But if you don't, you can lose that money. It's a type of leverage investment a lot of people don't talk about a lot. As far as I know, the options are not deliverable like the futures are on the COMEX, so you're not dealing as much in the actual physical trade, but it does affect the price. And especially, I think a lot of the banks push the futures around to meet their options price targets to make money. And I think a lot of times that's why you see gambling go one way or another on the gold and silver futures prices in COMEX, because they're trying to hit their options targets, because you can use one to affect the other. But it's interesting to see what type of derivatives we have. And if you take options and futures together, they're not as big as swaps and other types of derivatives. So futures and options are very important. They're a part of the overall derivative complex, but they're not by far the biggest type. Now you can see that commodities really, if you look in red, this is the red. Commodities is the smallest portion of the overall derivatives. Credit derivatives are bigger. Equity derivatives, which is the stock market's bigger. Foreign exchange, which is currencies, is bigger. And interest rate, things like swaps and other derivatives, are also bigger. So most of the derivative trading is in or around credit, Forex, which is currencies, stocks, and interest rates. So it's around money and bubble assets. It's not as much around commodities. So we don't even have a ton of derivatives in commodities when compared with the rest of the stuff. So commodities is by far is the least amount. Now, you can move the price around in futures commodities, even though it very easily, because it's such a small market compared to the rest. And that's why they do it. That's why when you look at a chart of the biggest short positions on all of the different derivatives on COMEX, it's in the precious metals, because they're such a small portion of the overall derivative complex. You can see here on the chart, it's easier to move them around. It would be harder to move interest rate derivatives because there's so many of them. Your position would have to be bigger. So that's why they get pushed around a lot. If you look at overall banks dominating derivatives, futures, and forwards are this amount, it's about 40,000 billion, so about 40 trillion in notional value. Certainly it's not the cash that they have to take those positions. It's a leveraged market, but it's about 40 trillion in notional value. But if you look at all the total notional value of all the derivatives, you're looking at 210 trillion invested by the 4 big banks in the US. This is 4 big banks. Who are the banks? It's JP Morgan Chase here, Bank of America, Citibank, and Goldman Sachs is named in this report. And of the overall amount of derivatives, Bank of America has slightly more than the rest. Actually, I think Citibank may have more. They're about 125, and Bank of America is about 50. And then JP Morgan's about 125. So these 2 banks on the left have the heaviest, and Bank of America and Goldman. That's just derivatives in general, not specific precious metals. As we scroll down and get more into the precious metals piece, I wanted to kind of break that down a little bit for you. Oh, I wanted to look at one thing. This is quarterly trading revenue as a percentage of gross revenue. So if you look at the 4 big banks, they're between 5 and about 12% right now of their derivative positions and how much cash that adds to the balance sheet. So certain banks, you're looking at 5%. It's a risk if your derivative portfolio breaks, but we're talking the entire derivative portfolio. The precious metals would be a minority or a very small portion of that overall derivative trade. So it's unlikely to put a bank like Bank of America out unless they had other derivative exposures or other losses on the bank. I don't think, a lot of people say, well, if the silver position busts, it drives Bank of America out. I don't think it does, because overall, as a percentage of revenues for Bank of America, you're sitting at about 6 to 7% in the derivatives complex. And if you go back up to this chart we're looking at before, the overall precious metals is only this little red sliver. And so they're investing more in interest rate foreign exchange and credit and equities than they are in the metals. So it's possible that a busting of the silver market could bust a bank like Bank of America, but more than likely the government's just going to bail them out because it's not a huge percentage of their overall derivative revenues, and it's an even smaller percentage of their overall revenue. So people that are hoping for a bust, you're probably going to be slightly disappointed that a bust in the silver market's not immediately going to put one of these banks out of it. And that's kind of why they can hold these positions. In fact, they could increase their short positions or whatever derivative positions in both the options and the futures on the COMEX a lot before it even gets close to looking at their risk in the equities market, the Forex market. It's more than likely if one of these banks is going to go out of business, it's going to be interest rates going the wrong direction and they get caught on the wrong side of their futures positions, or if the dollar or other currencies die and it causes an issue with their Forex or credit and stuff like that. Like the amount of credit in society is more than the amount of precious metals. So it's more than likely the banks would go under for one of those things, or maybe, the treasuries, interest rates rise and the treasuries are worth less at face value, and that drops their overall liquidity ratio and it puts them into like a danger position like it did Silvergate and all those banks from a couple of years ago when they went bust. More than likely, that's what's going to do it. I did want to look at figure 17, notional amounts of precious metals contract by maturity. And you can see that in 2022, this chart explodes up and it's like, well, did they all of a sudden have more precious metals contracts, these four big banks? And all the banks are trading them? No, they didn't. It's just a change in the way of reporting. Previously, a lot of the precious metals trade was put into the Forex category. And we saw how much bigger the Forex category was. So it hid the amount of derivatives in. But thanks to 2022, the OCC broke out the precious metals, and you can see the total notional amount specifically in precious metals, which is in the trillions. I believe it's right now it's over 5 trillion in total precious metals derivative contracts, not just futures and options, but swaps and all of it, all that stuff piled together. So that will kind of give you an idea of the scope of the overall precious metals market, where the price is likely to move. Like I said, if we have an interest rate decision to cut, gold's likely going to run. It's going to cause silver to continue to run. However, look for a pullback. Even if we get an interest rate cut, look for a pullback sometime this year, because gold in particular looks like, from a technical perspective, it's way too frothy. And at some point, the traders are going to try to take profits and reposition. And they're probably going to do that as we get closer to the December contract. So I expect at least one either retraction or plateau in the gold price this year, but the timing of that depends on what the Fed's going to do. Now, if the Fed comes out and does something crazy and they're doing a 0.75% rate cut or something like that, then forget everything I just said. But if it's the anticipated quarter point, and you look at the frothiness of the gold and silver market and the need for some of these guys to take profits and reposition for December, I'm totally expecting a revaluation of gold and silver down at least one time in the last quarter of the year, between now and the last in December, and that final futures contract positioning takes place. Where it ends up, we have no idea. Goldman just put their target at gold for 4,000 for the year, which is certainly about $300 and some change more than what we're sitting at. And so that's entirely possible. But look toward that Fed decision, look toward the technical charts on gold, silver. We'll continue to cover it as to what may happen there in the short term, but certainly long term. You look at what's going on in the world with de-dollarization, the risk, and the rest of the derivative complex, which I just showed you the American side of that and how much risk they have in all these other derivatives, the banking risk, the deflation, worldwide economy deflation risk. All of those risks are going to tend to point towards an economic crash, a move from a recession, which I think we've been in since 2008, to a global depression, and much higher gold and silver prices over the medium to long term. It's anybody's guess of what they do the rest of this year. That depends on the Fed, and it depends on how the banks position themselves according to the Fed. If the Fed holds even, then I expect gold and silver to come down in the next month because it's just gotten too frothy. If the Fed cuts, it probably goes up, and then whatever retracement we get probably would be pushed back a little bit further in the year. And that also depends on the economic data, which I started off covering. This big revision down of almost 1 million jobs during the last year is indicating that the government numbers are not correct. And when you look at a place like Shadow Stats, it gives you more realistic numbers. From John Williams is an economist that does that. It really paints a more bleak picture. And I think the world's figured that out. That's why gold and silver have risen. But we're still beholden to what the Fed does. So we still got to see what they do, and we got to see what the numbers are for the rest of the year. And in particular, heading into the final quarter, what I'm looking at is, in the U.S., I'm looking at consumer spend. The last quarter of the year is the holiday season. You're going to see a lot of consumer spend. If we have a lot of spend and it's not all on credit cards and somehow people are having free cash, then that's a bullish sign for the economy. But I expect, and we've already seen the credit usage start to tick up. We've seen how 4% total of the total labor force of Americans are now living paycheck to paycheck. More people are moving into poverty. I expect that we're going to see the onslaught in 2026 more officially of a recession depressionary cycle where the economists start to come out and acknowledge it and start to come out and say we need more Fed action. And I think we're about to get into that era of the economy over the next year to 2 years where the Fed has an incredible pressure, not just Trump jawboning, but incredible pressure from the entire market to continue to drop interest rates. Because if they don't, this whole thing's going to collapse. Remember, 37 trillion in debt. Remember, Rogoff and Reinhart wrote that book when they looked at the amount of credit. And once you get over 90% debt to GDP, and we reached a peak of 140, I think we're at like 120, 125 now, you're past the point of no return. You have to have that debt collapse and that revaluation, that currency reset, I think is going to go along with it because people are de-dollarizing. So certainly over the next couple of years, it doesn't look terribly positive overall for the economy, but that is positive for gold and silver if you're a gold and silver investor. And in the short term, we're looking at a couple of main things. We're looking at what the Fed does with interest rates. Does the job data continue to come in badly? Does the inflation data continue to come in badly? And do consumers show up in the fourth quarter in the United States to spend, as has traditionally been the case? That's why they call the day after Thanksgiving Black Friday, because that's the first day of the year that most retailers are in the black making profit because of the holiday sales. That's why it's called Black Friday. It's not called Black Friday because of a stock market crash. It's called Black Friday because that's when retailers in America finally get into black for the year when you consider everything, taxes that they pay, rent, employment costs, all that kind of stuff, input costs, all that kind of stuff. And if the consumer doesn't spend the last quarter of the year, it could cause a lot of companies to go bust. We could see the continuation of the retail apocalypse, and we had a few years ago during COVID, and you're going to see much higher gold and silver prices while you continue to have pressure on the dollar index and on interest rates and on bond valuations, face values. That's going to continue to assault the balance sheets of banks and of companies in the United States as well as the U.S. government. So that's all that we'll be paying attention to. So we covered a lot there. Hope you guys enjoy it. It's been this edition of the Freedom Report. Again, recording this on September 16, 2025. By the time you guys see it, you'll know what the Fed's done, and you'll be able to put two and two together where gold and silver are likely going to go for the rest of the year. And then we'll come back and report on again on our next show. Appreciate you guys. Thank you very much. Until next time, this is Rob Kientz with the Freedom Report.